Welcome to Oxford Real Estate Insights and our podcast on real estate research and practice, the Property Pod. I'm your host for this deep dive.
And hello from me. Today, we're really getting into something crucial.
Absolutely. We're looking at how climate risks, specifically wildfire risk, might actually be affecting home prices, that huge asset most of us hope to own.
And we're exploring this through some really interesting cutting-edge research. Our main source today is a working paper from 2023.
Okay.
It's titled, Does the Salience of Climate-Related Risk Affect Asset Prices? It's by Dr. Cloé Garnache, available on SSRN right now, and actually under review at the Journal of Financial and Quantitative Analysis.
Dr. Garnache, yes, she does fantastic work. Through our Oxford Future of Real Estate initiative, she lectures on real estate in the Executive MBA program with us at Oxford Saïd Business School.
That's right.
Her modules cover things like negotiations, auction strategies, valuing environmental amenities, and really key for us today, the impact of climate change on insurance and mortgage markets.
She's also affiliated with Housing Lab, Oslo Metropolitan University, the University of Oslo's Economics Department, and the Frisch Center. So really deep expertise here.
Definitely. And her research gets right to the heart of this massive problem, doesn't it? How do we as individuals actually factor these increasing climate risks into, well, huge financial decisions like buying a house?
The tough one.
Yeah. So our mission today is to unpack this paper. We want to understand what it tells us about how people price wildfire risk, especially, thinking about the awful wildfire events we've seen so recently.
It's a fundamental challenge, pricing this kind of risk.
Yeah.
How does an ordinary person figure out the odds, the potential cost, when they're looking at houses? It's not straightforward.
Not at all. It seems incredibly difficult, right? It's not like spotting peeling paint or an old boiler. Wildfire risk is, well, it's invisible until suddenly it isn't. Maybe people just lack the info, or maybe amidst the stress of buying, they just don't focus on it.
That lack of easy-to-grasp information is definitely a big part of it.
Yeah.
And that's why regulators sometimes try to step in. They might use things like risk zoning, drawing maps to highlight risky areas.
To give people a heads up.
Exactly. Partly it's information provision, but they also hope it makes the risk more salient.
Salient. Okay, what exactly do we mean by salient here?
So salience is when your attention gets drawn to one particular piece of information, like this house is in a high-risk zone, and then that piece of info gets maybe disproportionate weight in your decision.
Okay, like a spotlight on the risk.
Precisely. Policymakers worry that if the risk isn't salient enough, people just won't factor it in properly, which can lead to, well, mispriced homes and people facing unexpected losses down the line. And this isn't a niche issue. We're talking millions of homes in the U.S. alone in that wildland-urban interface exposed to this risk.
And wow, we just saw this play out so starkly, thinking about those California wildfires early in 2025. It's just horrifying.
Absolutely devastating. January 2025, those fires in Southern California, the Palisades Fire, the Eaton Fire, just terrible examples, and not isolated ones either.
No, the scale was immense. By late May 2025, what was it? Over 16,000 structures already destroyed statewide for the year.
It's hard to comprehend. And the property damage estimates, just from those early Southern California fires, we're talking tens of billions of dollars.
Tens of billions. So when you see or experience that kind of destruction, that level of actual loss, well, that's not just abstract information anymore, is it?
Not at all.
That has to be the ultimate form of risk information and salience, all rolled into one terrifying package. It's immediate. It's real.
You've hit the nail on the head. And that's exactly why Dr. Garnache's paper is so timely. It looks at a less extreme version of this, what happens when risk information is mandated through policy, specifically designed to increase that salience. How does that affect prices?
Okay, right. So let's get into that policy. What exactly happened in California back in 2007?
So California updated its fire hazard severity zones, the FHSZ maps. These basically show where the state expects fire hazards to be significant. They rolled out these updated maps statewide in 2007 using newer fire science. They classified areas as moderate, high, or very high hazard.
Okay, new maps. But the crucial part for the research wasn't just the maps themselves, was it? It was something else that came with them.
Exactly right. The real game changer for this study was the mandated disclosure rule that kicked in starting in 2008.
Mandated disclosure.
Yes. By state law, anyone selling a property after that point had to formally tell potential buyers which of these new risk zones the property fell into.
Wow. So imagine selling your house. The new map comes out, maybe it bumps your area into a very high zone, and now you legally have to flag that to every single person who walks through the door.
That's precisely it. For homes right near a boundary, one house might stay high, while the one next door flips to very high on the new map, and the seller of the second house must disclose it.
Okay, I see. That policy creates a really interesting setup for a researcher.
Absolutely. It's like a natural experiment.
A real-world laboratory, almost.
Kind of.
Yeah.
The government redraws lines on a map, then forces people to talk about those lines during a major transaction. Where those lines shifted, putting some homes into a riskier category right next to others that weren't changed, well, that's like flipping a switch. It lets the researcher compare what happened right around that switch, isolating the effect of the new zone designation and the forced disclosure.
Okay, that makes a lot of sense. So the big question then is, did making this risk zone salient, forcing the disclosure, especially right where the zone change actually moved prices? Or was it more about the underlying information about risk that the new zone reflected? How does she dig into this?
Well, Dr. Garnache used a really rich data set. She looked at home sales transactions, tons of them in wildfire-prone counties in Southern California, spanning from 2000 to 2015.
So price, date, location.
All that, plus house characteristics, size, age, bedrooms, whether it had a pool, the standard stuff. Started with over 2 million properties, then carefully refined the sample.
Okay, and she linked this to the risk zones.
Yes, critically. She mapped every single home to both the old fire risk zones and the new 2007 zones. And she measured exactly how far each home was from those new boundaries.
Very precise.
And here's a really clever part. She also brought in later much more detailed objective wildfire risk data, things like burn probability, actual risk to structures. Now, buyers in 2008 wouldn't have had this high-res data.
But she could use it later as a researcher.
Exactly, to see if the government's new map lines actually matched up with where the real underlying risk was highest.
Gotcha. So she could check if the policy zones reflected objective reality.
Right. Then, to really isolate the policy effect, the zone change, and the disclosure, she used some pretty sophisticated statistical methods, things like regression discontinuity.
Which looks right at the boundary line.
Yes, comparing homes just barely on one side versus just barely on the other. And difference in discontinuities, comparing that boundary effect before and after the policy, and also difference in differences, looking more broadly at homes that got rezoned versus similar ones that didn't.
Okay, different ways to slice the data to try and pinpoint the effect of just the zoning label.
Essentially, yes. Comparing apples to apples as much as possible.
All right, the moment of truth. What did she find? What happened to prices? Right there at the new risk zone boundary, where that mandated disclosure should have had the biggest, sharpest impact.
This is where it gets really fascinating. Using those methods that zoom right in on the boundary line, she found basically null effects on prices.
Null effects, meaning no change.
Pretty much. No statistically significant price jump or drop right where that policy-driven salience theoretically should have hit hardest.
Huh. That's counterintuitive, maybe. The law forces you to say danger zone right here, but prices don't flinch right at that line.
That's what the data right at the boundary suggests. But crucially, that wasn't the end of the story. She then broadened the lens, looked at homes over a wider area within, say, 600 meters of the boundary, or even further out, comparing those rezoned to a higher risk level versus those that weren't.
And what happened when she looked further away from the line?
There, the results changed. Over that broader area, homes that got bumped up by one risk level, say, moving from moderate to high or high to very high, they did see a price drop.
Ah, how much?
It's statistically significant, averaging around a 2.5% price penalty compared to similar homes that stayed in their old risk zone. And interestingly, this price drop seemed to be stronger, a bit further away from the immediate boundary, deeper into the newly designated higher risk zone.
Okay, hold on. So no price effect right at the boundary line itself, but a
Yeah.
roughly 2.5% price drop for homes further inside the newly labeled riskier zone.
Exactly that pattern.
So what does Dr. Garnache take away from that? How does she interpret this difference between the boundary and the broader area?
The core interpretation hinges on that difference. The null effect right at the boundary suggests that households weren't primarily driven by the salient shock alone, just the act of being told, you are now officially in the zone. Right at that line didn't seem to be the main price driver.
They weren't just reacting to the label at the arbitrary line.
That seems to be the case. Instead, the price drop observed further away suggests that people did update their understanding of the risk. They processed the information conveyed by being assigned to a generally riskier zone. But this informational effect wasn't just tied to the exact policy line. It seemed to register more broadly, perhaps where the actual risk was indeed higher.
And that connects back to the objective risk data you mentioned earlier.
Precisely. Remember, she checked that high-resolution objective risk data that buyers didn't have.
Yeah.
That data showed the actual wildfire risk didn't suddenly jump at the new boundary line. It was more continuous there. But the actual risk did tend to be significantly higher, further inside those areas newly zoned as riskier.
Ah, okay. So the price drop happened where the real risk was actually higher, not necessarily right where the government drew the line.
That's the compelling part. The pattern of where prices dropped aligns remarkably well with the pattern of where the objective underlying risk was actually greater, even if buyers weren't explicitly seeing that high-res data. It suggests their updating process was maybe surprisingly rational.
Wow, so it's like people were smarter than just reacting to a label. For a huge decision like a house, maybe they dig a bit deeper or have a better sense of the real risk landscape than just the zone map.
That's a really important implication. It suggests that for these massive risky assets, households might not just knee-jerk react to a policy-driven salience nudge, especially at an arbitrary boundary. They seem to process the broader information content, particularly when it aligns with objective risk realities. It might be different for, say, smaller consumer purchases where salience effects are sometimes found to be stronger.
Did she look at other explanations, like maybe different types of people bought homes further in or insurance change?
Good question. Yes, she explored other potential channels like sorting of buyers, changes in how many homes sold, or impacts related to insurance or mortgages. The analysis didn't find strong evidence that these other factors were the primary drivers of the specific price effects she observed. And importantly, California regulations at the time meant this specific 2007 zoning update didn't directly trigger changes in insurance premiums or availability based solely on the zone change itself.
Okay, so let's loop back then to the terrible reality of the 2025 California wildfires. How do these research findings about prices adjusting to credible risk information over a broader area relate to something as catastrophic as those events?
Well, the 2025 fires represent credible risk information in its most brutal, undeniable form. It's the risk actually happening, right? It's orders of magnitude more powerful than a change on a map in a disclosure form.
A completely different level of impact.
Totally. Remember, the paper found roughly a 2.5% price drop associated with a one-level increase on a risk map. The information shock from witnessing or being near a multi-billion-dollar disaster that destroys thousands of structures, that's immense. It validates the risk in a way no map ever could.
It makes the abstract terrifyingly concrete.
Exactly. And crucially, unlike the 2007 zoning policies study of the paper, which had limited direct insurance impact due to regulations, the sheer scale of losses from something like the 2025 fires will almost certainly have massive consequences for insurance, availability, cost. Those markets will react strongly.
Which then feeds back into property values, presumably.
Absolutely. Those real-world catastrophes hammer home the tangible financial stakes. They confirm the underlying premise of the research. Markets do eventually react to significant risk information. The 2025 events delivered that information with devastating force. So if we boil it down, the key takeaway from Dr. Garnache's research is that when it comes to huge investments like homes facing wildfire risk, buyers seem to be driven more by updated beliefs about the actual risk landscape, rather than just reacting to the policy-driven salience of being placed right on an arbitrary boundary line where the underlying risk might not change abruptly.
It suggests a certain rationality, perhaps, in how people process information for big decisions. Which leads to a final thought for you, our listener, to consider. Given the increasing scale and frequency of extreme events like those hypothetical 2025 wildfires, how will this ongoing, very real, very visceral information continue to reshape how risk is perceived, priced, and ultimately lived with in our housing markets? Something to definitely keep thinking about. Thank you so much for joining us for this deep dive on the Property Pod. We hope this unpacks some useful insights for you.
Yes, thanks for tuning in. We look forward to diving deep with you again next time.